Good afternoon, everyone, and welcome. Thank you. My name is Jeff Velastegui, founder and managing partner of the Legacy Group. On behalf of my partners, Rob and Matt, I want to thank you for being here this afternoon for this session on permission slip to spend. Retirement planning is one of those conversations we have with our clients often. And, one of those things that always comes up is the fear of running out of money, either because I don't think they have enough or they're spending too much, volatility. And it's a unique conversation because it's really different every single time, depending on who the client is and their spending habits. But everything you do, right? I think a lot of you may have heard me say this in the past, but everything we do is optional, right? Even how much we pay in taxes, right? So the volatility and the staying up at night worry of market volatility when you're in retirement is one of those things that it can be an option too, right? So what we hope to share this afternoon is really just a perspective on how some of our clients look at kind of their retirement and their ability to spend and live the life that they're hopefully saved for during retirement. So with that, let's get started. There is a slide on compliance. I have to remind everyone that although the information we're providing you is good, it's always advisable that you work with your accountants and CPAs because everybody's circumstances are a little bit different. So we have to remind that not everything we talk about might be applicable to you. So next slide, please. For a lot of you who are repeat attenders to our seminars, our mission is simple. We are here to help you lead a life of confidence, choice, and financial freedom through strategic planning and unparalleled advice. We do this through our three-dimensional financial planning process, where we incorporate mechanisms to ensure that every decision that's made in your planning is done through the view of not just your financial perspective, but also your legal and accounting. So with that, just understand that it doesn't matter if we're talking about retirement or estate planning, it's always through that lens that helps us identify planning opportunities. So today's, just quickly on the agenda today, we're going to talk about retirement planning, or the process, and the shift of mentality that you have to go through when you go from accumulating, right, years, right, which is all the years you're working through, until the day you say, okay, I'm going to retire. Now I'm going to enter the accumulation phase. What got you here won't get you there. So the strategy that you use to kind of climb the mountain is going to be a little bit different than what we're going to be using to climb down it. So then we're going to switch to the sources of income, guaranteed sources of income. They're limited sources, right? There's Social Security, which everybody has, right? Pensions, which not everyone has. We'll talk about how those pensions work. And then annuities, which is kind of, people think that annuities are bad. They can be in the wrong situation. So we'll talk about how an annuity can be a strategic move. We'll move then to what we call the 4-box income strategy, which is going to help you look at your income and expenses in a very unique way. And then we're going to close with a sequence of returns, which is something that everyone deals with on a daily and even annual basis. So your speakers today, Robert Sturges and Matt Wilkow, both my partners. We collectively have over 25 years of experience. They both have a really unique approach to retirement planning, focusing really on wealth management and working with business owners. So I think Rob is starting the first couple of slides. So thank you guys, and take it away, please.
Thanks, Jeff. I appreciate that. And to piggyback on what Jeff said, when it comes to retirement planning, obviously there are some analytical portions to it. There are financial components to it. But a lot of times the biggest factor are actually emotional and psychological. Heard a quote within the last couple of weeks that really resonated with me. Typically when people think about retirement, they think about their expenses while they're working, and they have a paycheck that comes in every single week, and they know what their budget is. And as that income comes in, as that budget is built, there are certain things that they may add to their lifestyle. Country club memberships, travel, going to shows, going to games, vacations with family. And I get a lot of people say, well, when I get to retirement, I just won't do that. The quote I heard was, a luxury once consumed becomes a necessity, as you see on the screen. And I think that's a key factor when you're planning your retirement. When you think about what retirement looks like for the first time in your life, every day is a Saturday. I heard someone say every day is a holiday, every meal is a feast. For the first time in your life, you don't have to make decisions based on what your work schedule will dictate and allow for. You've worked your entire life. These are the golden years, as they say, for you to enjoy the fruits of your labor. And if you've ever thought about retirement, a lot of people will think, well, in retirement, my expenses are going to be 70% of what my pre-retirement income is. And each year, whatever that number is going to slowly increase based on inflation. But as our next slide will show, retirement has actually been broken down into three phases: the go-go, the slow-go, and the no-go. And the reason for this makes a lot of sense. When we retire, we're the youngest we're going to be in retirement. It's going to be the most energetic we're going to be at that stage in our life. We're going to try to do everything we didn't have time to do because of other constraints that were levied upon us by our work. We're going to travel to Europe. We're going to go to Italy for 2 weeks, consume all the croissants and gelato we could possibly get, stuff in our faces. We're going to go sightseeing. We're going to enjoy everything because we finally can. This is typically those years of, ages 60, 65 to 70, 75. But what happens is naturally, as we age, our ability to be as active is not as good as it was previously. We're a little slower. We don't have the same energy, the same strength. And those 2 week Europe vacations, maybe they're 2 weeks in Florida. Maybe it's Niagara Falls, Lake George. Maybe we're going to Arizona. Still trying to do what we can, but we're not doing it as extravagant as we used to. And thereby, the cost to do so are going to be less. And what you'll see is as you age, those expenses tend to dwindle even more. And finally, we start getting into our late 80s, potentially 90s, and that's what we call that no-go phase. And unfortunately, that's the phase in life where we just don't have the ability, whether it's meant, cognitively, physically, to do much of anything we were doing before. We're still here. We still want to spend time with family, but most of our big, trips are to the pharmacy, to the doctor. If we're lucky, maybe to a family member's house for a holiday. But the thought process here is that, when we plan for retirement, we have to plan for some of those expenses to be relatively higher in the earlier phases and make sure that our strategy is set up properly to make sure we don't run out of money. And one of the things we always talk about is the foundation to a successful retirement is having an income stream that is stable, it is predictable, and it is consistent. In order to achieve those, Pam, if you could go to the next slide. As Jeff touched on earlier, there's only three ways to have that income stream that will be there on the first of the month, every month, regardless of market circumstances, regardless of political landscapes, regardless of anything. And those are Social Security. Those are pension plans with anyone who's working, for the state, teachers, cops, firemen, government employees have. And the final one is something that everyone can have if it is a fit for their financial needs, and that's an annuity. Our goal today is to go over strategies to implement to make sure that we can take the emotion and the psychological warfare out of retirement and allow you to just focus on what matters, doing the things we want to do with the ones that mean the most to us. One of the things we mentioned was that the stable, predictable, and consistent income stream we were all going to have was Social Security. But JP Morgan did a study, and what they found is that the larger your pre-retirement income was, the smaller percentage Social Security actually replaced when we reach retirement. And if you look at the screen here in the chart here, what you'll see is if you're making $30,000 in pre-retirement income, Social Security is going to make up roughly 3/4 of your pre-retirement income, which in most scenarios is going to be sufficient enough to allow you to maintain your standard of living. I don't know where everyone is dialed in from. Jeff is relocated down to Georgia, but Matt and I are still located in New York. And you can't live on $30,000 a year here. A lot of the people we work with are moving closer to the right-hand side where they're in that 200, 250, 300 plus income. And when you get to that level of pre-retirement income, what you're going to notice is that 250,000 or more, Social Security is only making up at most 20% of your pre-retirement income. So what does this mean? It means that the responsibility rather, for you to maintain your standard of living is shifted from the government and Social Security to your level of planning and making sure that you are taking the proper steps to accumulate enough revenue producing assets to provide that income stream. If you go to the next slide, one of the things that we always look at is there are multiple ways to plan for retirement, but we've seen sort of a shift in people's mentalities lately. And a lot of it has to do with the volatility that we're seeing in the market with everything going on in Iran, everything that's going on since tariffs have been levied. And one of the things that we have found most people resonating to is this 4-box strategy for retirement. And the thought process here is let's break up all of our expenses into 2 buckets: necessary expenses and discretionary expenses. The necessary expenses are those that we have to pay regardless of what is going on in the world. Our home, food, medical expenses, our property taxes, insurances. These are all things that the government, the township that you live in, the mortgage or the bank that you have your mortgage with, they don't want to hear that Microsoft is down 15% and you're not going to make the payment this month. That check is due, and it is due every single month. And the thought process is, well, if I know what my fixed expenses are going to be on a monthly basis, why don't I set something up so that I know that I have a deposit in my bank account every single month that covers those expenses? We try to cover those expenses with Social Security, with pension, and with annuities that can provide an income stream that you cannot outlive. And again, think about the power of knowing that on the first of the month, all of your fixed expenses are covered and you can maintain the standard of living that you are accustomed to. We don't have to worry about losing our home. We don't have to worry about eating tuna fish for dinner because we can't afford to buy anything nicer. We can provide the way we are accustomed to and the way we were looking forward to. Then what you do is you take those discretionary expenses, the expenses that have the ability to be changed: vacations, hobbies, golfing, gifts to children, grandchildren, and loved ones. If we utilize other asset classes such as stocks, bonds, mutual funds, certain cash value life insurance policies, other investments, if the market is not cooperating and we retire at a time where maybe it's 2022 where we have a down year and we're concerned about taking distributions out of an account that is down 10, 15, 20%. Well, if we know all our main expenses are covered and the only thing that we have to pull from that account to cover are the fun stuff, maybe we put some things on hold. Maybe we don't go on 3 vacations, we go on 1 or 2. Maybe we don't buy the new car and we just, continue to drive what we have for another, 12, 16, 24 months, whatever it takes to allow the market to recover so that we are not compounding down markets by taking withdrawals. And one of the topics that actually dovetails into nicely is what I'm going to hand over to Matt now. And that's kind of further illustrating why a strategy like this is so important. And it's because of all the variability that the markets have and the risk that you have with the sequence of returns. So with that, I'm going to pass it over to Matt, and he's going to take you guys home today.
Excellent. Thank you very much, Rob and Jeff. I appreciate that. And as Rob alluded to in this next segment, we're going to talk about the sequence of returns risk. And what's interesting about the sequence of returns risk is if not the most, it's one of the highest risks that retirees face. However, it is something that is rarely discussed or mentioned in the mainstream media or conversation around retirement planning. And it's a little bit of an advanced concept. So to illustrate it, we're going to use a hypothetical example. And that hypothetical example is 2 couples, right? We have the Hatfields and we have the McCoys. And there's a few things that are constant between the Hatfields and the McCoys as they embark on retirement. So first constant is that they're both 65 as they enter retirement. They both have $500,000 in their retirement account that is fully invested in the stock market. They both maintain a 4% withdrawal rate, so $20,000 a year they extract out of that portfolio, and that provides the income they need along with Social Security's pension and any other income sources that they have. Inflation is 3% in both cases, and they both experience a 9% annual rate of return over a 30-year period that they're in retirement. And by the way, that is the exact rate of return that the S&P 500 had from 1979 to 2009. So what's the difference? The only difference is that the McCoys, they experience those returns in the exact order that they were received from 1979 to 2009. So whatever the stock market did in 1979, that's what the McCoys received in year one. Whatever they received in 1980, that was in year two, so on and so forth, all the way to 2009 when they pass away. The difference with the Hatfields is that we reverse the order that those returns come in. So whatever happened in 2009, which was the last year of retirement for the McCoys, that's the first year for the Hatfields, so on and so forth down the line. Now, that doesn't change their average annual rate of return, because if I build out a table and I have in year one, here's a 10% rate of return, in year two, here's a 12% rate of return, so on and so forth down the line to year 30, right? If I flip those numbers, does that change my average? It doesn't, right? Because it still adds up to the same thing divided by 9, right? But the sequence, the order that those returns came in was flipped. So what kind of impact does that have for them? Well, what you see here in blue, this is how the McCoys portfolio developed over that 30-year period. So they start out with $500,000, as discussed. They take $20,000 a year out, which is what they need to support their retirement. And in the 80s and 90s, if everyone remembers, the market did pretty well, right? In the mid to late 90s, it did extraordinarily well. So you can see that despite the McCoys taking distributions on an annual basis out of that portfolio continues to grow. And by the time they reach age 86, it looks like, that was in the year 2001, their portfolio has swelled to several millions of dollars at that point. And that's when they experienced their first big downturn. In 2001, if everyone remembers, the dot-com bubble burst, the market lost about a third of its value. And so you could see that the McCoys experienced a significant loss. Now, while they probably weren't happy to see that at that time, they more likely than not were not worried that they're going to run out of money, because they still have millions and millions of dollars in their portfolio. Not to mention, they're almost 90 years old at this point. Over the next few years, they recover the majority of those losses, and then what happens? The 2008 Great Recession hits. They lose about 40% of the value of their portfolio. They pass away at that point, and they leave $2.7 million to their family. A pretty successful retirement, if you were to ask me, or anyone for that matter. So now if we flip the order of those returns, right, the sequence of those returns changes, and now the latter years for the McCoys are the beginning years for the Hatfields. What changes? Well, as you can see on this graph, a lot changes, right? The Hatfields, as they enter year one of retirement, the 2008 crisis happens, and they lose 40% of the value of their portfolio immediately. That's I can tell you from the experience of doing this that there's no one who's not going to be worried and concerned if in year one of retirement they see that 40% of their investable assets have dropped off. They recover some of those losses, but don't forget, they're taking distributions. They're taking $20,000 a year out, right? Why? Because they have to, because they're in retirement and they need this portfolio to provide income for them. So they're essentially compounding those losses, because as the market is going down, they're withdrawing money and they're essentially digging themselves, unfortunately, deeper into a hole. So even though over the next few years the market recovers, right, it then goes down again with the dot-com bubble burst. And from that point forward, the market is going to do very well, but the Hatfields have essentially dug themselves so deep into a hole that despite the market doing very well from that point forward, they're not able to climb out of that hole in the long run. And at age 89, they run out of money. And a lot of people see this and they say, well, how could that possibly be? They both experience the same 9% average annual rate of return. One of them passes away with $2.7 million, and the other one doesn't even make it. They run out of money at age 89. And that in of itself displays the sequence of returns risk, right? The order that the returns come in, the sequence that the orders come in matter, as this demonstrates. When it doesn't matter is usually during the accumulation phase. If these were two 30-year-old couples who weren't taking distributions and they were just saving money into their retirement accounts, right, this would look very different. But the game completely changes when you enter the distribution phase of your life, which is retirement. And the strategies that got you from 30 to 60 aren't necessarily the same strategies that are going to get you from age 60 to age 90. And the sequence of returns risk is a real thing that you have to be guarded against. So what do we do about this? Right? If we go to the next slide, Pam, please. So the first thing that we do is that we have to identify our guaranteed income sources, right? And those are going to be one of three things. It's going to be Social Security, it's going to be a pension, and it's going to potentially be annuities, right? So we have to first say, okay, well, what guaranteed income do I have coming in? If everything goes poorly with the market, right, what can I count on? And we then, in step two, need to map our necessary expenses to those guaranteed income sources. And we need to make sure that the guaranteed income sources are either covering our necessary expenses or at least getting as close as possible to covering those necessary expenses, so that we know if we happen to be the Hatfields and not the McCoys, right, while that's not going to be fun, at least we have income coming in to make sure that all of our necessary expenses are covered. Because did the McCoys have a better strategy in place than the Hatfields? No, they had the exact same strategy. The McCoys were just lucky, and the volatile years in the market came at the latter end of their retirement. And unfortunately, the Hatfields were extraordinarily unlucky, and those bad years came in the beginning. And then step three, once we've made sure that our necessary expenses are covered by our guaranteed income sources, we need to stress test the remainder of our portfolio against this sequence of returns risk, which is very simple. If the market drops 40% in the first 3 years of my retirement, does my income structure hold? Right? What additional strategies can I look into to guard against this sequence of returns risk? And something else I'll mention is that there are strategies that clients pursue that allow them to take advantage of market upside, but provide protection against loss if the market doesn't cooperate. So if we end up being like the Hatfields and experience significant volatility in the beginning years of our retirement, we have protective strategies in place that cover or protect a lot of our investments. And when we do this, when our necessary expenses are covered by our guaranteed income, we can spend with our discretionary assets without fear. And like the quote says at the bottom of the slide, that's not reckless, that's a plan. Pam, if we go to the next slide, please. So what's our next step, right? Our next step is to schedule a complimentary consultation so that we can review what your retirement income plan looks like, right? How are your assets positioned against something like the sequence of returns risk? And to do that, you can use the QR codes that you see here on the slide. You can scan that on your phone. That'll take you directly to the section of our website where you can fill in your information to request an appointment, and someone from our office will contact you. But before we end today's meeting, and hopefully we have the opportunity to meet with as many of you as possible, I think we did have some questions that were put into the chat box, Pam, is that correct?
Yeah. I have two questions that came in. For anybody else who hasn't figured it out, you are able to submit a question using the chat in the chat feature in the webinar. So, all right, the first question is, how do I know if my guaranteed income truly covers my necessary expenses once I factor in taxes and inflation? I don't know.
I can take that. I'll take that. When doing an analysis, what we're going to look at is we're going to try to understand what your true expenses are. We're going to try to understand what you need to survive in retirement. we're then going to take a look at all of those guaranteed sources. We have the ability to plug in those sources, and based on the income you're going to generate from Social Security, from pensions, from investments, we can dictate or we can see what the actual tax liability you're going to face is based on current tax guidelines. So we can run those projections and see exactly where you're going to be and whether or not you're going to be sitting in a surplus or a shortfall. We can then project outward based on average inflationary numbers to see if that surplus is going to maintain, if there's ever a point in time where that surplus is going to become a deficit, and what the probability of success is that this strategy will provide you with the lifestyle you're accustomed to and shield you from unwarranted volatility or a sequence of return risk that Matt focused on earlier.
Okay, great. And there's one more. Matt, I don't know if you want to piggyback on anything he said, but there's one more question.
Sure.
It says, if market drops significantly, how does a four-box strategy protect my long-term plan?
Sure. So I can comment on that one. So the four-box strategy essentially protects, takes the necessary steps to ensure that your fixed or necessary expenses are being covered by guaranteed income sources. So by guaranteed income sources, what we mean is that it doesn't matter what happens in the market, whether the market goes up, down, or sideways, right? You have money coming in on the first of every month to ensure that all of your necessary expenses are covered. So that really wouldn't affect that portion of your lifestyle and your retirement. Where it could potentially affect is that with your discretionary assets that you have outside, right, of your fixed income sources, if those experience a significant loss and you don't have protective strategies in place, that could affect how much you can spend on discretionary items, things like travel, vacations, gifts for grandchildren, things along those lines. So, what it is a prudent step to take is to say, okay, well, now that my fixed expenses are covered by guaranteed income sources, I check that box. What steps can I take to make sure that I protect as much of my discretionary expenses as possible? Because nobody wants to live in retirement just paying for their fixed expenses, right? To Rob's point before about the quote, right? We all have luxuries that we consume that don't feel like luxuries anymore. They feel like necessities in our life that we certainly don't want to necessarily give up. So that's where we want to explore some protective investment strategies that allow us to take advantage of market upside, but protect against downside.
And if I could add to that, another benefit of setting things up under this four-box approach, if you have enough of that stable, predictable, and consistent income to cover a majority of expenses, you're potentially not putting as much stress on the other assets that you have and the other investments you have. So theoretically, as long as you are living within your means, that bucket of money should be growing. So if that bucket of money is able to accumulate and grow, even when we have a potential down cycle in the market, it may not have an ultimate effect on you because, again, that's ancillary money that has not been touched, has not been stressed based upon the fixed income strategies you have implemented to cover your expenses.
Yeah. All right. We don't have any more questions. So thank you again for joining us this afternoon, guys. Really appreciate it as always. We welcome any questions after the fact through an appointment or an email. Looking forward to working with all of you guys. Thank you very much. Have a good afternoon.
Thank you, everyone.